Recently, China has been selling off US Treasury bonds. These are the same government bonds that keep America's massive debt funded. When China sells them, it creates ripple effects across the entire global economy. At the same time, the trade war has taken another sharp turn. After the United States raised tariffs on Chinese imports, China struck back with tariffs of its own. What started as a 104% tariff quickly escalated into a spiral, with the US imposing 145% tariffs and China retaliating with 125%. This clash is about much more than trade. It is about financial power, and the bond market is at the very center of it. So why is the bond market such a big deal? Because it determines interest rates that affect everything from mortgage payments to credit cards to the cost of running governments. Most people believe the Federal Reserve is in full control of interest rates, but that's only partly true. The Fed controls short-term rates, but long-term rates, like the important 10-year Treasury yield, are set by the market itself. And right now, the market is reacting to China selling bonds. Here's why that matters. Bond prices and yields move in opposite directions. When bonds are sold off, their prices drop. And when prices drop, yields rise. For example, if you hold a bond that pays $50 a year and that bond is worth $1,000, the yield is 5%. But if the price of that bond falls to $900, you are still getting the same $50 a year, but now the yield has jumped to 5.5%. Multiply that by hundreds of billions of dollars worth of bonds, and you can see how selling pushes interest rates higher across the entire economy. Higher interest rates make it more expensive for the US government to borrow money. With over $30 trillion in national debt, even a small increase in borrowing costs has a huge impact. If rates climb too high too quickly, parts of the economy can break under the pressure. That's why investors are nervous and why policymakers are being forced to adjust their strategies. China knows this. By selling treasuries, it's not only retaliating against US tariffs, but also defending its own currency, the yuan. When China keeps the yuan strong, it prevents too much capital from leaving the country. To do that, it sells dollars and buys yuan. And to get those dollars, it sells US bonds. From the outside, it looks like punishment. But in reality, China may have no choice. This situation echoes something from the past. In the early 1990s, the British pound faced similar pressure. Back then, the UK tried to keep its currency pegged within a European system, but its economy was weak, inflation was high, and interest rates were already stretched. Traders realized the pound was overvalued and started betting against it. The government tried to defend it with higher rates and by spending reserves, but the pressure was too much. Eventually, Britain was forced to withdraw and its currency crashed. That day became known as Black Wednesday. The parallel today is that China is also being pushed into a corner. It has two options. 1. Weaken the yuan to make exports cheaper and offset tariffs. But that risks inflation, capital flight, and financial instability inside the country. Or 2. Defend the yuan by selling US dollar reserves, which means dumping US treasuries. That's the choice we are seeing play out now. But the United States is also under pressure. Higher bond yields mean higher mortgage rates, rising costs on car loans and more expensive credit. For the government, it means refinancing trillions of dollars of debt at higher interest rates, which could lead to massive budget strains. Investors are watching closely, and many are pulling money out of the US stock market until the uncertainty clears. This is why the bond market is the true battlefield. Stock prices go up and down, but the bond market determines the cost of money itself. If China continues selling, the Federal Reserve may be forced to step in by buying treasuries. That would be a form of quantitative easing, essentially printing money to stabilize the system. But that path comes with its own risks of inflation and long-term instability. The worst-case scenario is a complete financial decoupling. That means the United States and China would no longer trust each other's currencies or financial systems. The world could split into two competing economies, each with its own reserve currency. We are not there yet, but every step in this direction increases the risk. For now, both countries are racing against time. China is burning through its reserves to defend the yuan, while the US is struggling with rising borrowing costs. Neither side can sustain this forever, which means pressure will eventually force negotiations. What happens next depends on whether the two largest economies in the world can find common ground before financial markets force their hands. Until then, the bond market remains the most important signal to watch. It tells us where interest rates are going, how expensive borrowing will become, and whether the global economy is heading towards stability or deeper conflict. So, while the headlines focus on tariffs and trade battles, the real drama is unfolding quietly in the bond market, and the outcome could shape the next chapter of the global economy. But let's take this one step further and think about the bigger picture. When bond yields rise sharply, it doesn't just affect governments and corporations. It affects everyday people in subtle but powerful ways. If mortgage rates go up, housing becomes less affordable. That means fewer buyers, slower home sales, and declining property values. If credit card rates climb, families already stretched thin by inflation feel even more pressure. Car loans, student loans, business loans, everything becomes more expensive when yields rise. And because the US dollar is still the world's reserve currency, these effects spill over into other countries as well. That's why many economists say the bond market is like the heartbeat of the global economy. When the pulse quickens, it signals stress that eventually shows up everywhere else. And right now, that heartbeat is racing. There's also another layer. If the Federal Reserve does step in with large-scale bond buying to push yields back down, that adds trillions of dollars of new money into the system. In the short term, it can calm markets, but in the long run, it risks pushing inflation higher. That would mean the same people already paying more on loans and mortgages would also see prices continue to rise at the grocery store and gas pump. In other words, the medicine might fix one problem while creating another. And then there's the question of global trust. For decades, US treasuries have been considered the safest investment in the world. Countries bought them not just for returns, but because they believed America would always pay its debts and that the dollar would always hold its value. But if one of the largest holders of that debt, China, is now actively selling, it forces other countries to rethink their strategies, too. Some may start to diversify into gold, into commodities, or even into alternative reserve currencies. That slow shift could change the financial system we've all lived under since the Second World War. This is why the situation feels like a high-stakes chess game. Every move has consequences. The US applies tariffs. China responds with tariffs and bond sales. The US watches yields spike and considers cutting rates or printing more money. Investors move capital around the world looking for safety. And in the middle of it all, ordinary people are the ones who feel the effects, often without realizing why their mortgage, their rent, or their credit card bill just got more expensive. Looking ahead, there are a few possible scenarios. One is that both sides keep escalating until something breaks, whether that's the housing market, the stock market, or even the bond market itself. Another possibility is that both countries realize the risks and come to the negotiating table using the financial pain as leverage to reach a new deal. And the third scenario is the most uncertain, a gradual decoupling where the US and China slowly build parallel financial systems that would reshape trade, investment, and even geopolitics for decades to come. Whatever happens, we are living through a moment that future history books will talk about. Just as we look back at the Great Depression, the oil shocks of the 1970s, or Black Wednesday in the 1990s, people will study how the US and China fought their economic battles in the 2020s. And the lesson is clear. Keep an eye on the bond market. It may not make flashy headlines like the stock market, but it is where the real story is being written right now.